What's up guys, Raymond here with our episode 10 of our financial statement analysis videos in our German industrial stocks. Without further ado, we're going to get into the key ratios straight away. If you're new to my financial statement analysis videos, what we do in these videos are we analyze the top 3 financial statements in relation to a stock or a company, those being the income statement, the balance sheet, and the cash flow statement. And we pick out each of the key factors relevant to each statement, and we try to come up with an idea of how strong the company is financially at the current date, or today's date, and how well it's done in the past, and we attempt to come up with an idea of how well the company will do in the future. So without further ado, we're going to start off with the key ratios, and we're going to get into the income statement, then we're going to follow up with the balance sheet, and then we're going to end with the cash flow statement. So let's get in. So the market cap is 6.63 billion euros. The market cap is the overall price of the entire company, based on the individual shares of the company multiplied by the price of each share. The revenue figure, which is the overall sales of the company in the last financial year, was 4.7 billion euros, which is definitely a very strong revenue amount. The dividend yield, which is the amount of cash paid out to each shareholder, was 2.41% of the share price, or of the entire price of the company. So the PE ratio, which is the price of each stock divided by the earnings per share, was 18.53. The earnings per share was 2.02 euros. The beta level, which is the risk level as a number, according to the volatility of the stock up to this date, is 1.08. So it's 8% above the market average of 1, which is definitely a very, very strong figure. It shows that the company's stock isn't too volatile, just a little bit over the average, but not too volatile. Let's get into the income statement, which is the first of the financial statements. Some call it the some call the balance sheet the statement of financial position, and there are different names for each statement, but I'm going to stick with the income statement for now, the balance sheet as the balance sheet, and the cash flow statement as the cash flow statement. So the income statement shows that the revenue figure is definitely a very, very strong figure, 4.88 billion euros on average, and it's managed to maintain that amount of revenue for the past 3 financial years, give or take a few million euros. The profit margin, which is the dark purple figure, was negative in the 2019 financial year, not by a tremendous amount, but negative profit is always a negative factor, a negative thing. It's always a turn off for potential investors as well as current shareholders, and it causes a lot of people to sell stocks, short stocks in the future, and it doesn't do well by the stock price as well as the entire company. The 2020 financial year, the revenue stayed around the same, decreased a little bit, but the profit margin increased to a positive level. So it definitely went into the positive profit margin level, but it was very, very tiny. The profit margin was very, very small. So later on, when we check the balance sheet, when we check the total liabilities of the company compared to its assets, we're going to see how highly leveraged the company is, how much debt it has, and we're going to attempt to come up with an idea of whether or not the company will do well just in that area alone. Because if a company is over leveraged, or if a company has too much debt compared to assets, and if it has a small amount of profit, a large percentage of the profit is going to have to be paid out in interest fees alone to the creditors. So let's get into the last year of the income statement, which is the 2021 financial year. The revenue stayed around the same, around 4.88 billion euros, but the profit margin increased quite a decent amount to around 3 to 8%, which is really, really good. If the company can manage to keep this earnings growth the next financial year, which is the current 2022-2023 financial year, it should be even higher, to around 10% or more, which is definitely a strong figure. So let's get into the balance sheet, as we said, which depicts the liabilities as a ratio to assets being the light purple figure, and the total liabilities being the dark purple figure. As we can see, it's close to around 65 to 70% over the past 3 financial years. Of course, the 2020 financial year was probably the worst. The 2019 financial year probably the best, because the revenue figure, which is the light purple figure, has been around the same. The 2019 financial year, the company managed to have the lowest level of debt compared to assets, so around 60%, which is definitely a good amount. I would say 50% debt to asset ratio is definitely probably the best position to have. Otherwise, anything more and interest fees will just be doing too much, taking too much cash from shareholders' pockets. So the 2021 financial year was about the same as the 2020 financial year. So overall, I would say that the company definitely needs to improve its debt level. Its debt level needs to reduce the amount of debt it has to be able to attract new shareholders and to be able to keep the current shareholders happy. So let's get into the last of the financial statements, that being the cash flow statement. So we can see how the company manages its cash and how it manages to generate cash. So the company started off with a net income of 305 million euros in the 2021 financial year. It had operating income of 682 million euros, and it managed to spend 112 million euros on capital expenditures and other cash flow items, the majority of which went to capital expenditures, and the minority of which the company managed to generate 17 million euros in cash from other cash flow items. So the financing activities managed to expend 479 million euros, which a large percentage of which went to dividends paid out. So 153 million euros was paid out in dividends to stockholders, which is definitely an attractive thing for companies to do. 93 million euros went to buying back stock, which is definitely a good thing also. And also 290 million euros, which is a large amount, went to eliminating debt. So as we said earlier, if the company can reduce its debt, it will definitely be make the company more attractive stock to shareholders. So foreign exchange effects came to 16.3 million euros, and the net change in cash for the 2021 financial year was 106.35 million euros. Let's just check the net change in cash for the 2020 financial year and 2019 to see if the company is growing or not. So 467 million euros net change in cash in 2020, and the net change in cash for 2019 was 160 million euros. So there's not a consistent earnings growth. It's quite sporadic and volatile, but it's always been positive, which is definitely really good for shareholders. Shareholders always want to know if the company's got a lot of cash on hand. Of course, it can do a better job of having more cash, so it can avoid certain risks associated with capital, for example, capital adequacy risk and other forms of risk, credit risk, etc. So having a large amount of cash on hand definitely reduces that exposure to that risk. But without further ado, I'm going to close this video. Thank you guys for watching episode 10 in our financial statement analysis videos, analyzing a company called GEA Corp. GEA Group, and episode 11 will be analyzing another stock. I hope you guys are around to watch that video. Thank you guys for watching again. I will see you in the next one.